So, Sasha, I will be your buffer. I will try to gain a bit of time like this. I mean, people will get in. So, officially, good morning to all of you from a sunny Brussels. We have very high expectation to a sunny weekend. So, we really hope that will be probably the only really sunny weekend that we will have in September. So, we are very much looking forward to it. It's a great pleasure to see you all. So I invite you to put your camera on if you want. Like this, we can see each other to have a real communication, a real debate. And also, as an housekeeping information, we are recording the event, so also our friends in Canada and in the US will be able to see and watch the recording once it will be on our website afterwards. It's a great pleasure to introduce you to the latest edition of the Fact Book. It's a bit the Bible of the cover bond community, as we all know, but I would like to say that really our community has been built around this exchange of knowledge. That was really the concrete example that our community wanted to share views from different angles, from a geographical angle, from a different sides of the market, from a different role in the market. So, because this is really a compendium of views and interpretation of what is happening this year in the covered bond market from all the different angles of view. Sharing opinions, I think, is the motto of the ECBC. And we are very much a content-oriented organization. The content is everything in the plenary meeting, in the fact book, and in all our database that we have been building over the years. I would like to express on behalf of all the ECBC members a big thank you to all the contributors of the fact book. Of course, Sasha, I mean, the merit of the coordination, you are the maestro coordinating this amazing orchestra here, and together with Joost, that has been coordinating the statistical side, you have really been able to coordinate and find the compromises around more than 100 contributors for this fact book. We think that this is really the pillar of our organization, and today we wanted to give you a flavor of the discussions and trying to invite you really to read every single chapter in this book. This year, I think this publication is more important than ever because the European Banking Authority is analyzing the covered bond market, is analyzing how the covered bond market has been reacting to the implementation of the covered bond directive, and there is no better source of information of the fact book to discover how every single market has been implementing the covered bond directive. A few words on the cover. Every year, the staff has a long discussion about what cover we should be using. Together with Eva and the other member of the staff, we went for a very nice building in Paris. Of course, EBA is based in Paris, so we thought it was the right city. And Haussmann probably is one of the most important promoter of the cover bond around the globe. So we selected a very nice building in Haussmann style in Paris as the cover. If you have a good suggestion for next year, don't hesitate to send your proposal to the Secretariat. We will be more than happy to consider this for you. Sasha, I think that I gain a few minutes. I see a bit of critical mass, so I pass you the floor and I thank you all for the amazing work done for the ECBC this year. Thank you very much.
Yeah, good morning, everybody. Thank you, Luca, for the kind introduction, the kind words. I can only echo what you've just said. Huge work has been done by many, many contributors. And you said that we are expecting a sunny weekend, and what else can you do but reading all the chapters of the ECBC Factbook during the weekend? As an alternative, or maybe as an introduction, you just listened to our very nice panel. Today, I do have a few contributors with me here. The panelists, Larissa, Joost, Stefano, and Florian. And before we start, I would just like to ask you to introduce yourself very briefly, and maybe we start with Larissa. Larissa, I can't see you, but I guess you are there, right? Maybe you just introduce yourself.
Can you hear me well?
Yeah, perfectly well.
Okay, perfect. Yes, hi, good morning, everyone. Indeed, my name is Larissa Fritz. I work together with Joost within our financial markets research department at ABN AMRO. While I don't have specifically a focus on covered bonds, I do cover within the team everything related to ESG, fixed income on a cross-asset base.
Thanks very much. And next to you sits Stefano, at least virtually, on my screen. So Stefano, please.
Good morning. Good morning. I am the current chairman of ECBC for 2024 and 2025, and also moderate the ESN task force within the association. In my daily job is with Intesa Sanpaolo. I am head of regulatory impact assessment, so it's in the institutional affairs area of Intesa Sanpaolo. Many thanks to all.
Thank you. And now let's move on to Florian.
Yeah, morning all. My name's Florian Eichert. I head the covered bond and SSA research for Crédit Agricole, based in Frankfurt. And in addition to that, I'm a member of the ECBC steering committee.
And last but not least, of course, Joost.
Yes, good morning all. I'm Joost Babont. Indeed, I work with Larissa at ABN AMRO in Amsterdam, and I'm heading there the bank research, focusing, of course, also a lot on covered bonds, and also the chairman of the data statistics working group of the ECBC.
Perfect. Thanks very much. As Luca mentioned, content is key at the ECBC, and not only regarding content. I think the Covered Bond Factbook is the outstanding publication. Whenever you want to know anything about covered bonds, have a look at the Covered Bond Factbook. If you always wanted to know about the Armenia covered bond market or about Switzerland, just have a look. You find all information in the Factbook. It literally covers all existing covered bond markets around the globe. The Covered Bond Factbook also explains the core features of the covered bonds in the generic section, and you find detailed information about the rating methodologies of the leading rating agencies. The focus today will be on the hot topics that has been discussed over the recent months and are still playing a very important role in the covered bond market. And before I hand over to Joost to give us some feelings about the covered bond market, please let me highlight this is supposed to be an interesting discussion. And even though our panelists definitely will give very nice information about everything, please take the chance to interrupt, to ask questions, or to make any comments so that we are going to have a lively discussion. But as I've said, nothing without figures. And Joost is the master of statistics, and I would like to hand over to you, Joost. Give us some information about the covered bond market.
Well, I think the ECBC is the master of the statistics, as we compile the data with a lot of people, so it's not only me. But let me take you through the highlights of last year's exercise. I tried to do it briefly, as maybe not the most exciting part of this panel, but I think this chart tells quite an important story. And if you go back to 2003, that's also when the series started. Actually, we had 1.5 trillion of covered bonds outstanding. And actually 20 years later, this amount has risen to 3.3 trillion. Last year, 230 billion more covered bonds were outstanding. It was a growth rate of 8%. It was actually the strongest growth that we saw since 2008. And you can clearly see since, 2017, 18, the market is growing again. That of course also shows recently that banks are repaying cheap loans from central banks. They need to rely more on wholesale market funding, and that supports the covered bond product. So a new record reached last year with 3.3 trillion outstanding. maybe going to a bit the breakdown by type of covered bond, or the collateral backing the covered bonds. Now it's clear 2003 it was still a large part public sector, but mortgages have really taken over. So I think 90% is now backed by mortgages. Public sector, I think, is 8% share, and then we also have, of course, ships, covered bonds, and others, which remain a bit of a niche. Maybe to the next chart that shows the where do the issuers come from, and here I think also good to look at back in history, 20 years back in time, when there were only EU issuers issuing covered bonds, of course, reflecting that the product already exists for more than 250 years in Germany, and also for a long time in France, etc. But covered bonds have been also explored and by issuers around the globe. So we see from recent years, of course, issuers from Asia Pacific, North America, which is Canada, and South America joining the market. Of course, South America not really in euros, so it's more domestic market. But the share, for instance, for Asia Pacific is now 8%. So clearly, the covered bond product is becoming more and more a global product and an important funding tool for banks across the world, with now more than 10% of issuers coming from outside the EU, which is a positive development, I think, also for investors in terms of diversification. Maybe the next slide, I think we get a bit, okay, how are our bonds, how are they sold? Of course, you can this is a bit of an indication of the liquidity of the market, although we will discuss this a little bit later on maybe as well. But you can, most bonds are placed in benchmark size of 500 million and above, publicly placed at investors. That is almost 2,000 billion at the moment, is sitting somewhere in the books of portfolios of covered bond investors, it's quite an important market in this respect as well. And then, of course, you also have private placements, which include the retained covered bonds that banks tend to use to pledge as collateral in liquidity operations at central banks. Last year, this also grew by one big French bank issuing almost 100 billion in retained covered bonds. They replaced another program I think they had for liquidity. So this market is also important for banks, as it gives them a collateral for liquidity operation in time they need it. Then next slide is of course, as always, a nice one is who is leading, but as you can see, also going back in time, 2003, well, the German market was way bigger than any other covered bond market, with more than 1,000 billion of Pfandbriefe outstanding. Well, that has come down, and actually Denmark has took the lead in the past, I think, what was it, 5 to 7 years. But actually last year, France is now number one with 3 billion, I have to be honest. So it was close. In fact, if you look at the chart, it's Germany, France, Denmark, which are the biggest covered bond countries, and Denmark, of course, because it has a very large domestic market. Next slide, please. And this shows a bit the outstanding amounts by country. Like I said, France, Denmark, Germany leading, but then you have also Sweden, Spain, Netherlands, Switzerland, actually Canada, which and Italy, maybe Norway, also quite important covered bond jurisdictions. And in total, actually, from 34 countries, and I think we had 180 issuers across the globe, I think. So there's a bit off the top of my head, I should know, but move on to the next slide. is the hard soft bullet structure. Also here, nice to look back. Of course, this is the maturity structure of covered bonds has been a big debate in the past years, also with the covered bond directive. And the covered bond directive played a quite important role here because, as you can see, it's currently 66% have soft bullet structures and 33% are in hard bullet format. While 6 years ago, this was a bit the flip side. And with the covered bond directive allowing soft bullet or extendable maturity structures, a lot of countries have embraced the structure, and issuers as well. At a German market fully moved from hard to soft, and that has been quite impactful on the statistics as well. So soft bullet structures are now the dominant feature. Conditional pass-throughs are actually, we're 3% now, almost 1%, and I think might be reduced in the coming years. Next one, we can skip this one. Let's move to this is a bit what currencies are covered bonds issued, and these are outstanding amounts, of course, and it's quite a constant. 60, 70% is in euros, of course, reflecting almost all issuers of most issuers from EU countries. But domestic currencies, these are the Danes and the Swedes, Norwegians are key here. But also interesting to see the other currencies. So that's non-domestic, non-euro, which is say UK issuers issuing in Aussie dollar, or Australian issuers issuing in sterling. Well, this market it's a small share, but it's rising. So I think this is another kind of evidence that the covered bond market is globalizing, with issuers using also different currencies to fund themselves in, which is of course also a good development. Next slide is about the issuance of last year. Well, as you can see, actually issuance rose further last year to almost 700 billion, and it was already following the jump that we saw in 2022. Actually, last year was only 2011-12 were years that we saw more issuance. So and that of course also resulted in the 3.3 trillion. I think here it's good to mention that actually covered bonds were, I'm not sure whether there's some regulators here, but covered bonds proved their crisis-proof nature following the mini banking crisis, and also some geopolitical tensions rising. We had quite some turbulent times in 2023, and covered bonds were actually the asset class to reopen the market, and also to allow banks to keep having access to funding. And of course also reflecting the large issuance volumes in the past 2 years is that TLTRO loans have to be repaid, and more basically it shows that banks rely again more on wholesale funding with covered bonds. Their cheapest funding tool and an important part of their total funding mix. Moving on is. Now, here you get a little bit again the soft hard split, and actually, if you look at new issuance, almost 80% is in soft bullet format. So we don't go back with the slides, but the share of soft bullets in the total is likely to increase further, and actually the share of hard bullets is likely to come down. And then I think in the coming years that will maybe roughly stabilize a little bit. Moving on. Again here the public-private, and as you can see also last year 400 billion placed in benchmark format with investors, a bit of similar volume as the 2022. So that should be supportive for liquidity, as there's a lot to choose from for investors. But also like I said, the private placements were increasing last year. Moving on is now we move already a little bit to the topic we're going to discuss soon in the panel, is about sustainable covered bonds. Of course, there's still a lot of work to do to make the energy transition really happening across the globe. And well, this chart shows in 2014 the first, you can't really see it, but the first sustainability covered bond was issued. And now this chart shows that the amount of sustainable covered bonds that are being issued is rising. Actually, last year it rose above the 100 billion mark and is now above 120 billion. Also, what you can see is that's also at the next slide, so maybe go there, is that the majority is in green format, while actually say 10 years ago the split was a bit more equal, but currently it's quite a constant share of say 70%, slightly more in green, and then we have social covered bonds and sustainability covered bonds, which are of course a mix of green and social. The market is growing rapidly. I think that's maybe the next slides in terms of issuance as well. Last year, more than 30 billion issued. I think this year we're already at around 16 billion. So not sure whether we will get to the numbers of last year, but last year was like 5% of total issuance. So it's still a bit of a niche. If you look at total outstanding, the sustainable covered bonds are just 3% of the total. So it remains a niche, but yeah, this market is likely to grow as well as as like I said, there's still a lot of work to do in terms of making the housing stock energy efficient. Maybe move on to the next slide. Not sure what that one is. About the countries with most outstanding sustainable covered bonds. Not surprisingly, maybe Germany, France leading again. Also, Norway has relatively a lot of they have more than 15 billion outstanding of sustainable covered bonds. Korea, maybe to highlight, they issue a lot in social format, so the share they have almost 70% of all their covered bonds is sustainable. And we have more and more countries now joining. I think currently it's at 17 countries which are issuing sustainable covered bonds. And then I think we move to the last slide. I hope everybody is still there. This slide is from actually the first chapter, from the key themes in the fact book made by my colleague that's Maureen from ING. And this is about the use of proceeds. And of course, covered bonds, now with the presentation you just had, it's mainly backed by mortgages. So it should not be a surprise that most of the use of proceeds are going to green buildings. If you see the split here by country, I think the number of issuers are in brackets, and she looked at covered bonds in euros with a minimum size of 250 million, and then where the proceeds have been allocated to. Now it's mainly green buildings, residential, commercial. Actually, residential is the majority, more than 56%. And then in the public space, you can see that affordable housing is the majority is allocated to affordable housing. Of course, these are maybe a little bit introduction. You have the ICMA green bond principles, you have the EU green bond standards, and these allocations are to say the top most energy efficient buildings. And like maybe now I stop here is with the energy transition. Also, if you look at the task for retrofitting and making the existing building stock more energy efficient, I think, and we also discussed a bit in Porto, I think covered bonds are quite well positioned to finance these at reasonable cost. So hopefully we do see more sustainable covered bonds being issued. But I now give over to Sasha to discuss
Perfect.
more about the sustainable covered bond market.
Perfect. Thanks very much. Richard, I see your hand, but please allow me to thank Joost and all others who collected the figures for each country's again, because I know it's a tough work, but it's a very important work. Without any figures, it's very difficult to talk about markets. I think you all know this. So once again, thanks very much to you, Joost, and all others. And so first question, Richard, here we go.
Thank you. And yeah, echo that thanks, Joost, for all the great work in the presentation. You spoke about the 8% growth in the market, and you briefly mentioned it being about weaning ourselves off central bank support. But obviously, a lot of that central bank support was on the basis of covered bonds as collateral. Yeah, maybe it's impossible, but is there any way of breaking down the number, that 3.3 trillion number, into retained covered bonds and non-retained covered bonds? Because it's, strikes me that the 8% growth is 8% growth in the number of bonds outstanding, not in the number of covered bonds owned by third parties. Is it impossible to quantify retained bonds?
Joost, I think this question goes to you.
Yeah, I'm still there. Yeah, I was looking at the data. No, we have, of course, in the data and also in the Excel file a breakdown by the public placements and the breakdown by private placements. And the private placements actually include also the retained covered bonds. And I think that most of the private placements are retained covered bonds, of course, because normally private placements are relatively modest in size in general. And if you have, say, the private placements are, I think it's say 1/3, 2/3, more or less. So 1/3 is in private placement format and 2/3 are in public formats. And actually, the trend here was for private placements to go down. So the past years we saw a bit of a trend of private placements. Exactly the reason why you said they were used as ECB collateral, and banks got these back, so we're not using it any longer. But then, last year, and Florian can also tell a little bit about it. But there was a large French bank that they issued almost in one day 92 billion of retained covered bonds. So to be honest, if you correct for that, but yeah, that's of course also not fair because it is what it is. But if you correct for that, actually the private placements would have gone down last year.
Just one extra comment on that. It is a good proxy for most jurisdictions to look at private placements and assume the vast majority is actually retained, with the exception of the Germans, where private placements have historically been a very, very large part of the supply and the outstandings. Now, it's true it's not been that busy in these past few years, but when you look at some of the private placements from the German market, they would have been very long-dated transactions with insurance companies, pension funds. So for the Germans, I wouldn't sort of take that as a proxy. For most other jurisdictions, yes. And as you said, my dear employer, or rather the parent company, we've got close to 100 billion outstanding in a separate vehicle that is only used for retained purposes. Just one extra comment on that. Even once you know or have a rough idea about the retained amounts, what you still don't know is what those bonds are actually being used for. Yes, the vast majority would still be used for ECB repo, but there's a growing market with banks using those with third parties, be it for term repo financing, 1-year evergreen, 2-year, 3-year tenors where you generate NSFR eligible funding. Or whether it's to use them as collateral for collateral downgrade trades, or there's a lot of different varieties that are being played these days. So it's no longer retained equals everything sits with the ECB. Retained can mean quite a few different things, and I agree it's tricky to keep track of that. I keep track of the supply by just looking at the ECB collateral database, but with retained bonds that can be cancelled any day, it's really hard to keep track of the actual outstanding volumes. But still, as a proxy for all the jurisdictions except for the Germans, I think it's not too far off to just look at the private placement and assume the majority is indeed retained.
Thanks very much. Any additional questions on that aspect? Or if that's not the case, I don't see all pictures of you, so sorry if I miss any raised hands or something like this, but you could also put a question into the chat if you want to. Joost, you mentioned that the sustainable covered bond market is a success story. Certainly it is, even though it's still a niche product somehow, but it's growing. And you also mentioned the ICMA Green Bond Principles and the EU Green Bond Standard. And in 3 months' time, banks or other institutions will be able to issue EU bonds with this official label, EU Green Bond Standard. So Larissa, my question to you, what is it actually? What are the requirements on the Green Bond Standard, and what are your expectations? How will banks make use of this Green Bond Standards? Not only referring to covered bonds, but more in a broad picture.
Yeah, thanks for the question, Sasha. I think maybe to answer your first point, good to note that well, when the EU Green Bond Standard was being drafted, there was a lot of consultation with market participants, and the idea was as well that they didn't want to cause too much disruption. So, you know, that being said, a lot of the requirements under the EU Green Bond Standard build already on the market practices that are being applied at the moment, and also, you know, requirements and things that are included in the ICMA Green Bond Principles. I think, of course, there are a few key differences there, and one of them, which is the one that also makes it the most challenging for issuers to comply with, is, of course, the requirement that the proceeds of the bond need to be aligned with the EU taxonomy. And I think specifically looking at, you know, banks, as you mentioned, that can be challenging. I think part of, for example, the ECBC fact book is an article where we have an overview of how much of the financial institutions across the EU are aligned with the EU taxonomy at the moment, so based on their lending activities, and that's based then also on Pillar 3 reporting. And there you can see that I think the largest from top of my head is around 10% here in the Netherlands, but you do have countries where this goes as low as almost 0%. So I think that very well, you know, the fact that only by having this requirement where you have to align proceeds with the EU taxonomy, it can prove to be a little bit challenging. That being said, you know, also looking specifically at you know, the mortgages, which are also in most of the cases the biggest part of the lending activities of banks, you do have some activities which are easier to comply with looking at the EU taxonomy, such as, for example, you know, you have to just make sure that the EPC, that the building has an EPC label of A, for example, or complies with the top 15%. It's already very much close to what we have as market practice. You know, most of these green covered bonds, also the ones that, for example, have a CBI certification, these already comply with that. But if you're looking, for example, at renovations, or if you're looking at, for example, financing of new buildings, so buildings built after 2021, that becomes a bit more challenging, also because of the presence of the do no significant harm. So you have to also prove, for example, that the water tap usages of the new building comply with, you know, a certain threshold, which can, for banks, you know, since they are giving out mortgages, they're not the ultimate owner, they're not building, they're not the property developers, can be quite challenging. So I think that's one of the things. Of course, you have some other differences here and there. I don't want to go into too much detail, but for example, you have the EU Green Bond Standard differentiates between whether you are financing a portfolio of assets, or whether you are then, so you have different requirements whether you're financing a portfolio of assets, or if you're then reporting specific assets. So, you know, on a portfolio basis type of reporting, and on a bond basis type of reporting. For banks, it's easier because, for example, the portfolio basis is only indeed around financial assets, which is indeed the core of what banks are financing. So they can also consider then, continue with the portfolio approach, which is the most commonly used in the market at the moment. But, looking maybe a little bit away from financial institutions, that might also be a challenge. So, maybe I talked a little bit too much, but I think in a nutshell, these are, I think, the requirements. Of course, you have some other things around post and pre-issuance review as well, which might be not what current green bond issuers are used to, might be also a bit more challenging. But overall, the idea of the green bond standard is also to enhance the credibility of these bonds, to give investors a little bit more assurance, around minimizing risks of greenwashing. So, there are some other things there, but I think in a nutshell, that's it. And of course, then on your question, Sasha, definitely the biggest challenge is and will continue to be around proving that you have alignment with the EU taxonomy.
Okay, I understand there are some challenges related to that, especially with regard to the taxonomy. What does that mean for the use of the green bond standard? Does it mean that hardly anyone will use the label, or do you expect that the EU green bond standard will be the new premium covered green bond, and especially investors, and I'm going to ask this in a second to Florian as well, will asking for this kind of issuance, green issuance? Larissa.
Yeah, that's a good question. I mean, it's hard for us to kind of predict how the market will evolve. I'm definitely sure that there's going to be, especially, the issuers out there who are front runners in this market, that they will try to comply with the EU green bond standard, and the whole idea of having an EU green bond standard is as well that it is the golden standard in the market. It's also how it was, put by the Commission. So I think that's the idea. It's not that it's also on a voluntary basis. Let me also be clear here. So it is an idea that, you can continue issuing green bonds as normal. But on the other side, if you want to go one step ahead, and hence, have kind of the golden label in the market that you can issue EU green bonds. I do think that, some issuers will indeed try to comply with it. But again, coming back to the requirements of the 100% EU taxonomy alignment, not considering the flexibility pocket, that you will also not be able to issue all of your bonds in EU green bond standard format. So I think even the ones that are front runners, I think there's going to still be the same issuers that will eventually go back to the normal green label. But I think, of course, if you have been able to issue an EU green bond, I think that already builds on investors' credibility and the benefit from an investor side. But of course, I will let Florian comment on that later, is of course the fact that investors also have to do their own reporting. So in the EU, you have the SFDRs, the Sustainable Finance Disclosure Regulation, where investors themselves have to also start to disclose, how sustainable their investments are. And the investors also have a key incentive to buy these EU green bonds. So both on the supply and the demand side, there are some benefits. But, it's not something that's going to be easy to comply with. So I think you might see some issues, but in the long run, I think it's still going to become a very niche market, I would say.
Okay.
Yeah.
Thanks very much. And I just want to mention that apart from the green bond standard, which covers also the transparency part, the disclosure part, you also have other sources, for instance, the HTT, there it has been approved with regard to information on sustainability. So there are other opportunities to get more information about sustainability of covered bonds. But Florian, Larissa already mentioned investors. You talk a lot to investors. So what's your view on this? Will investors ask for EU Green Bond Standard labeled covered bonds, or don't they care at all?
Now, look, if you give them the choice, they would go for the better standard, but there is no choice at the end of the day, or very little choice that they have. And if you ask them whether they're happy to have 20 odd euro billion in ICMA green bond principle based cover bonds, or 2 billion in European green bond standard based bonds, I think they'll go for size over quality, because the main point still is there's not enough supply for this, and I think people would be happy to settle for, call it second best, if it means they can transact in bigger volumes than having to wait for one green bond that is aligned with the EGB from an issuer every 3 years. I mean, that's again, if you have enough supply, then clearly they would prefer the stricter standard, but that's not the options that are on the table. So ICMA green bond principles is well accepted, and even with that broader basis, there's not enough supply in the sense to satisfy all of the interest, because issuers are simply still working with limited amount of identified assets on their balance sheets, and very often rather choose to use those for senior preferred, non-preferred, or tier 2 transactions, where there's most of the times a bigger advantage from a pure financial angle. So bigger savings on the initial premium, or in terms of spreads in more general terms.
But investors could, of course, put pressure on the issuer to ask them to work harder to achieve taxonomy alignment earlier. Is this something that is being discussed with investors, or are there other topics more in the focus when you talk to investors?
To be honest, I don't speak to investors a lot about these, let's say, call them nuances, or sort of green bond standards versus ICMA green bond principles. That hardly ever comes up. The topic that comes up at the moment is completely far away from ESG. That's more about supply outlook, what are competing asset classes doing, why is there so much weakness on the SSA market side, is that putting pressure on coverage? Those are the discussions, and you also have still some discussions around CRE, commercial real estate assets, but green bonds, or in general sustainable issuance, there are questions as to how much is the expectation for supply, but as I said, there's very few that would go, and I want to know how much the actual supply is that will be aligned with the EU Green Bond Standard. That rarely, if ever, comes up.
Yeah, okay. It looks like the priorities are different on the investor side. Nevertheless, there is some pressure on banks to improve their disclosure on climate risk and all other related things. And Larissa, you already mentioned Pillar 3 disclosure. So maybe before we move on to the next topic, some more information about disclosure requirements and what could come there. And you already raised your hand, Larissa. Perfect match. So
yeah, I actually just I'm gonna go to your question, but I just want to comment on something as well that Florian mentioned, is at least from our conversation as well with investors, is that a lot of them are implementing, they're taking bits from the EU Green Standard and putting into their own requirements. So, for example, the EU taxonomy alignment, while this is 100% under the EU Green Bond Standard, some of them are, having a threshold of 60%, 50%, whatever. So they're taking also, bits in there and having their own kind of evaluation process. So, it's also something that once the EU Green Bond Standard is live, although you might not see so much uptick, you might have kind of spillover effects into the whole green bond market. While, for example, even normal green bond issuers, they might be more incentivized than to disclose how much of their proceeds are aligned with the EU taxonomy. And while not being 100%, so they're not eligible for applying for the EU Green Bond label, they might still, come out with, let's say, a 60%, 70% aligned green bond. And this will feed and be fine, let's say, for investors, since it meets their own thresholds. So sorry, just wanted to add that. But indeed, on other type of disclosures, well, you have a lot. I could speak, I think, the whole morning here about the different disclosure regulations in the EU. I think indeed one of them being the Pillar 3, which is key. We have already seen, the most recent Pillar 3 reportings already including a whole ESG section, which, already means that there is more and more ESG data from financial institutions coming to the market. I think the other interesting one as well to mention is, of course, the CSRD, so the Corporate Sustainability Reporting Directive, which will start as of 1st of January. So, basically as of annual reports of 2024. So, data that's also supposed to still come to the market. But, mainly then as well for financial institutions, that's going to give us information around the green asset ratio, for example, which is also, very, very interesting. And of course, let's say that the difference between that regulation and the Pillar 3 is that banks are going to already have also information from the parties that they finance. So, thinking maybe away from mortgages, but, large corporates also are under the CSRD, while the Pillar 3 is only for banks. So that being said, you might also then have more reliable data, let's say, coming to the market via the CSRD. So I think that's also another one which is interesting. I think these are the two main ones, Sasha. I think the other ones you go into too much detail. You have, for example, the CS3D, so the for due diligence as well, which is also now being discussed, expected to come into place. You have as well, which already mentioned, of course, that the EBA is working on potentially also including green requirements or assessment of kind of ESG risks into the covered bond directive. But I think that's something that's still being discussed at the moment. But might be also something that's going to be part of the disclosures of financial institutions that fall under the covered bond directive. So there are, I think, different things coming up. Of course, one of the biggest challenges is how this is all come together, and maybe there's also interesting to refer people from this call to the fact book that we published actually last year, where within the article that I wrote, we drew kind of a map where we see how all of these regulations kind of feed together. So indeed, one piece of information that is being disclosed on one side can actually feed into the disclosure of another side. So maybe that's also something interesting, for the audience. But I leave it to there. Yeah.
Thanks very much. Worth reading, definitely. You mentioned that EBA has been asked to look at ESG risk in covered bonds and more disclosure requirements, specifically for covered bonds. This is also part of the call for advice to the European Banking Authority. The call for advice by the EU Commission was already released last year. Nevertheless, EBA has moved forward a little bit. There was an industry roundtable in April where both supervisors and representatives from the industry took part. And then EBA sent out a questionnaire in June. The deadline was mid of August. And Stefano, I would like to ask you, because you attended the roundtable, the industry roundtable, and of course, as the current chair of the ECBC, you are the right person to ask. What's your view on this call for advice, on this questionnaire? What is your impression? What are the most hot topics being discussed, as far as you can tell us? So please give us some insights there.
Many thanks, Sasha. Yes, the roundtable has been in April that you mentioned, has been a very important moment, I think, for the industry and for the regulators. So basically, you know that the covered bond directive mandated the European Commission and the EBA on certain specific topics after the entry into force of the directive. And so authorities are working and are trying to assess how the market is working with the implementation of the cover bond directive, if the cover bond directive, generally speaking, attained the goal, the goals that were announced at the time in 2019. So regulators are interested in answering to some specific questions, and also to I will come to that in a moment, and also to see if there are, let's say, some opportunities of development, further development of the directive. So basically, the roundtable has been, well, there has been quite a large explanation and debate on the topic of extendable maturities. So as you know, the cover bond directive introduced into the legislation something that the market had already digested. So the extendable maturities, and how it was as it was shown by the histograms of Joost a few minutes ago. We have seen that extendable maturities cover bonds are now, I would say, the norm. So the legislator has, in a certain way, regulated something that the market had already introduced and validated. And I mean, investors know very well how extendable maturities of bullet cover bonds work. But the roundtable took quite a lot of time in discussing and quite a extensive explanation by market participants of how the extendable maturities work. And the real, what is the topic here? The topic is that there are some, let's say, national differences which are allowed by the European directive on the functioning of the, let's say, technical functioning of this extension mechanism, like triggers, for example. But this has to do, so this has been explained and discussed during the roundtable. But this has, of course, to do with the fact that the cover bond directive is a principle-based legislation, which intended, let's say, to harmonize the cover bond, the EU cover bond market, while preserving existing national specificities, because cover bond exists since, well, in Germany since 250 years, as we know, and in other countries since a long time, and are well established. And the legislators did not want to disrupt what is already working very well. So this is the reason why some features of the cover bond directive are still, let's say, regulated for some technical aspects at national levels. So this is exactly what has been discussed during the roundtable. It has also been put forward by market participants that the cover bond directive has been implemented in the various EU jurisdictions very recently. So also to say, if the cover bond directive has deployed its full effects, maybe it is a bit too early, but the message from our association, from market participants, is that the level of harmonization which has been reached thanks to the introduction of the cover bond directive is pretty significant as of now. Therefore, we are as a community of issuers, I mean, pretty happy with the current status. However, the mandates that were given to the Commission and to the EBA give also some, let's say, open to some new opportunities. So one of the opportunities has just been discussed by the colleagues preceding me, so by Larissa and others, and Florian and Joost, about, let's say, the sustainable or green, the introduction of a green cover bond. So I will not go into that. It has been sufficiently explored in depth. So thanks to the colleagues. But the other opportunities are the introduction, so these are specific mandates to the European Commission, the introduction of a new legislation for a new dual recourse instrument backed by SME assets, and maybe we'll come to that later on this morning. And the other opportunity is to introduce in the EU a third country equivalence regime. So we have seen still, I mean, from I recall the graphs of Joost, the importance at, let's say, global level of issuances of cover bonds by banks of third countries. They are they are growing and they're extremely significant. Therefore, there is the case for the introduction of a third country equivalence regime. So this is an opportunity also for EU banks, not only for third country issuers. So it's a reciprocal interest to go on this path. So this is. I think the roundtable, so the April roundtable was very useful. After the roundtable, as Sasha mentioned, there has been this questionnaire which distributed to stakeholders. It was not, let's say, public consultation, but it was, let's say, consultation targeted to some market participants, and it went quite into the details. It was a detailed questionnaire. There were some specific questions for issuers, some specific questions for investors, and also some specific questions for other market participants. So this has been designed in a very, let's say, constructive way by the EBA, and during the plenary that took place last week in Porto, there has been a public speech by the EBA representatives, and what has been said on the questionnaire is that the EBA was received quite a number of responses from market participants, and their estimation is that the respondents cover more than 50% of the EU cover bond market. So the answers received were, of course, significant in that respect. So I would not take further time, and maybe we can follow up later. Sasha, tell me what you think. You are the maestro here for organizing our conversation. Thank you.
Well, thanks very much, Stefano, for this overview. Florian, you mentioned earlier what investors are currently interested in, and if I'm not mistaken, it didn't cover the covered bond directive call for advice. So isn't this a topic at all for investors, or are there some topics that are of interest for investors?
I mean, what Roberta said in Porto, quite a few investors actually did respond. So it's not like this is a non-topic. It's not a spread driver. That's maybe how to explain it. It's not something that would make investors differentiate based on the improvement compared to previous times, or that there's no more an active differentiation and spread differentiation across jurisdictions based on the framework. So it's seen as, I don't want to say positive background noise, but it's seen as something that, yes, people are following, but it's not what makes them invest or divest from certain jurisdictions. What is interesting or is of interest is clearly the potential for third country equivalence that is relevant for the bank treasuries, the HQLA portfolio investors in Europe. But it's been, put it that way, dragging on for so long already, and chances are it will drag on for a good bit longer, that it's also not something that would be taken into account into your internal capital cost calculations, into the spread targets that you need to meet, because again, we're talking about the EBA writing the report. From what Roberta said in Porto, there's a broad consensus that is in favor. So I would think the way she phrased it, the EBA would be in favor as well. I mean, don't want to jump to conclusions, but that's the impression and the feeling that I had. What happens with it afterwards, that's to me the bigger question, whether the Commission will actually take this and do something with it, or whether the focus is simply more on the securitization side and therefore not so much on the cover bond proposals that may in the end just get put into a drawer, and the drawer gets closed and then they sit there for a while. So directive is not the big topic. It's more, as I said earlier, supply outlook. We've come from 2 years of very, very limited supply because of the TLTRO to 2 years of very heavy supply because of banks refinancing the TLTRO. Now we're effectively the first year in a market that is more driven by underlying fundamentals, loan growth, deposit growth, product choices across the capital stack when it comes to funding. Those things are much more important when you talk to investors. What is the expected supply between now and year end? What is the supply outlook into 2025? Those things are important because, and that's the next really important thing, we still look good as an asset class versus many asset classes. So cover bonds still attract interest from credit buyers that weren't there before, because we have very positive market evolution on the credit side, while cover bonds and SSAs have been widening. So we still look good in that context, but we no longer look quite as good versus SSAs. So I have a lot of discussions these days with investors as to what I expect for the European Union, both supply as well as spread wise, because that is starting to put pressure on also cover bond markets in tenors 5 years and longer. And we've seen very limited supply these past 2 weeks. Whatever we have seen was very short dated. So in a way, issuers are just sidestepping the issue by going short, because that's where we still look relatively good versus other asset classes, more so than in the longer tenors. But eventually, banks will also have to return to 5, 7, or 10 years, and that's where the trouble lies at this very moment. Again, it's not an issue of capacity constraints. It's not an issue of excess liquidity dropping too fast, or the rotation to fixed income coming to an end. It's none of that. There's enough money to go around to absorb EGB supply, SSA supply, and cover bond supply. But the big question these days is really about relative pricing across asset classes, and above all, at this point, relative pricing to SSAs. That's what's keeping investors and I think also issuers up at night. On the issuer side, again, it drives sort of timing of funding and the tenor choices, and you can sidestep your natural needs for some time, but not forever. And eventually, again, either SSAs tighten or something has to give and covered steepen. Those are sort of the discussions we have at this point quite frequently in almost all meetings.
Okay, so let's stick for a second to the market. Joost, what's your view? So we've just heard that there are pros and cons. What's going to prevail in the near future? Do covered bonds look appealing to you or not?
That's a good question. Now, I think Florian, he summarized it quite nicely. And I think the good thing is he also looks at SSAs, and I'm more looking at the bank side of things. And at the bank side of things, actually, you can hold a complete different story in a way, because covered look very appealing versus, say, senior preferred bank bonds with the spread having compressed there, and covered bonds have really underperformed the senior preferred asset class. I think this year and also last year. So I think that is also behind asset managers stepped up to the plate this year. So it's quite interesting from a if you put covered bonds in a rates bucket, then basically they don't look very appealing, especially versus SSAs, which is a more liquid market. If you look at the credit side of things, they do look appealing. So something's got to give, and there are multiple things that can give. But I think what Florian is saying is right at the moment. If you look at the pickup for covered, especially at the longer end of the curve versus SSAs and maybe even versus govies, it's not that much. So I think in that respect, covered bonds do not look appealing at that part of the curve. That's also why we see the issuance at up to 5 years. Now, all the investors that spoke up during the conference and that I spoke to with coffees, they only buy up to 5 years basically. So that's where the demand is. That's where the value is. Still, if I look, for instance, for a German Pfandbrief and a KfW bond, then you get a pickup, say, in the 27th of 17, 18 basis points, which, if you do the math, might still be attractive from a fixed income portfolio manager perspective. But yeah, maybe if you take into account liquidity of the market, etc., then investors turn more to the SSA market. So a bit, I'm still, of course, doing the thinking for next year. But if the market remains where we are now, when we do see, someone joined suddenly. No, okay, but that's good to hear. People not leaving at least. So and, so yeah, you can. If SSAs remain very attractive for especially HQLA investors, it could mean demand might drop a little bit from that side. But on the other side, if nothing happens in the credit market, then we might see more asset managers allocating more money to cover bonds next year. So I think it's the jury is still out, but I think there will definitely be pressure on the longer end for cover bonds to steepen there.
There's maybe one thing to add, Sasha, just briefly. The weakness in a way that we've seen these past 2-3 weeks. Well, again, it was above all European Union widening, but it's also we're mid-September at this point, but it almost feels like we're in November already when it comes to investors. I've had so many meetings lately where the focus is already on January 25, and books they're not closed, but if you take bank treasuries, most have finished their investment programs for the year when it comes to volumes. Unlike on the SSA side, and fair enough, performance hasn't been quite as good as on senior pref or further down the capital structure, but still cover bonds are tighter than where they were at the start of the year. So many of these HQLA buyers would be done with their volume targets. They'd be okay with their performance targets. So there's no real pressure at this point to start chasing anything. So you have a buyer base that sits there going, do you know what? If something looks appealing, we'll buy it, because liquidity is not an issue at all in terms of having money to invest. But if that isn't the case, so if you just have some, I don't want to say random 5-year trade at tight levels, but that no longer gets anyone excited, when at the start of the year that was still the case. Move into early 25, all those volume targets are back to I mean the completion percentage is back to 0, and you start again from scratch. So even if RV doesn't change materially, would still be in a better market than we are at the moment as far as demand is concerned. And as I said earlier, the big trends are still there. The big trends with credit buyers coming in in principle, they're still there. They slowed down more recently, but again, that's because of good performance and having bought a lot already at the start. The big trends on the banking sector side with excess liquidity coming down really slowly, that is still intact. The money is still there. And as I said earlier as well, the big trend in terms of increasing your fixed income allocation, that is still, really, really early days in a way. I had the pleasure to moderate a panel in Porto, and Henrik Stille from Nordea, investment manager, said on there saying one of his pension fund clients used to have 25% allocated to fixed income. That dropped down to 10% at the start of this year. They've increased the share of fixed income, but they've basically moved from 10% to 10.4%. In 6-7 months, just to highlight the time it takes to have these bigger trends play out. So absorption capacity, I'm relaxed. That's not an issue. It's again comes back to an element of calendar effect. So are you at the start of the year? Are you at the end of the year? Are dealers long? And if so, how much time do they have to recycle until you get to your end? And where do investors stand with their investment programs for the year? At the moment, a lot of these things are on red. Come the January 1st, a lot of these things turn back to green.
Okay, thanks very much. For me, it sounds that we shouldn't expect a huge supply wave for the rest of the year, which isn't too bad. And we've already had quite a huge issuance volume this year. Joost, you showed a picture that the share of Asian covered bonds has increased to 8%, if I'm not mistaken. So you said the covered bond market is becoming a global product, or has become a global product. And even without having this third country equivalence we were talking about earlier. So is there really a need for the third country equivalence, or put it the other way around? Does any one of you expect a decline of issuance from non-European countries, third countries, when we won't see the third country equivalence soon? Maybe Joost or Stefano, any views on that?
Yeah, maybe I can start here. I think the chart showed actually the number of issuers. So that's, if you look at the volumes, maybe the chart looks a little bit different, of course, but with Canadian issuers being quite heavily, they issue in large volume. I think with the third country equivalence, what was already said, is that of course it can definitely help non-EU issuers if they get this equivalence. But I think it was a clear message from Roberta from the EBA. They reason from a EU perspective. So why would you grant a Canadian equivalence if then EU investors will buy more Canadian covered bonds rather than German Pfandbriefe, for instance? So you would cannibalize a bit your own market. I think she does see a reason to give this equivalence, but the aim is in the end also to increase, say, the foreign investor base, so Canadian investor base, Japanese investors that maybe start looking at covered bonds, get to know the covered bond product. I think there's a large role here, also for the ECBC in terms of education still, educating the rest of the world about, now getting a little bit sentimental maybe, but the beauty of the covered bond product, but also the benefits that it can give to banks in terms of cheap funding. And that, of course, the more global it gets, the more global investors might also know the product. And now you hear with the Basel implementation in Japan, for instance, that it has become attractive for Japanese investors to invest in covered bonds. So if that really plays out, let's see, then you really get more like a global covered bond market with investors coming also from more different places than now it's very concentrated to EU in investors. So that can definitely help. But what Florian was also saying is the EBA seems supportive, but Roberta, and correct me if I'm wrong, she was quite clear. They will give an advice. They will say to the European Commission, we might think it's a good idea to start discussion about equivalence and take this kind of framework into account when you start discussing equivalence with the regulators of the non-EU countries. Now that means that you get like bilateral discussions. It can easily get into political territory. Yeah, here I see some hurdles, and indeed also when after the Draghi report, which is more to revive the securitization market, the European Commission might indeed think, well, we put it in a drawer and let's take it out of the drawer later, and that might be never. So I think it will drag on for a while, and I think hopes have been, yeah, it has been a bit of a roller coaster ride. But to me, it sounds like there's still a long way to go to get this third country equivalence. But then, in itself, we have a blueprint with the covered bond directive. That blueprint can be used by non-EU countries. The Canadians, the Koreans, the Australians, they all show. Singapore, we had yesterday a 3-year DBS covered bond deal in euros. They got almost 2 billion of demand. So there is a good appetite for also for non-EU issues. I think it's like, yeah, I do call it more like a spinning wheel. So if we see more non-EU issues, we might also see in the end more non-EU investors. Don't know whether this answers the question fully, but
thanks very much. Stefano, you want to add something?
Yeah, thank you. Yes, something basically what I understood. Well, what I understood, it was, hinted by the EBA, because we are interpreting now. So the facts are, I mean, the current figures are that show us that even today, in the absence of a third country equivalence, there are, let's say, huge issuances and from third country issuers, and also huge investments from EU banks in those bonds. So this is our starting point in the absence of the equivalence. But what I understood, I interpreted in the words of the EBA. I mean, I agree also with what has been just said before me. It is granting the equivalence is a long process. It's a bilateral process, so it's between the EU, the Commission, and the relevant third country. So it's bilateral, but the European Commission has to set beforehand the general guiding principles for this equivalence. So it is a huge and long work. And in my understanding, it's a matter of priorities. So we also understood from the EBA that the big priority now for the, let's say, relaunch of the Capital Markets Union is the revamp of the securitization. So where the EU legislators will put their efforts first, we can presumably and foresee that their efforts would be put into the securitization first before in the third country equivalence of covered bonds. But this is just an interpretation. Of course, things have not been said exactly like I am telling you now. So. But this is my personal understanding. So it's just a matter of priorities. But the important thing, I think, for us, it is that the EU, the Covered Bond Directive, is now the benchmark for all global issues, all global issuances of covered bonds. So this is the important thing. So even to put some reflections in the third country equivalence regime goes into, let's say, still, reinforcing the EU benchmark in the covered bond space. So this is what we have to bear in mind. So I think that so the EU is leading on covered bonds and setting the benchmark. This is the important thing. Thanks.
Thanks very much. I fully agree. It seems to be that the focus, the priorities have shifted more towards securitization from a regulatory perspective. Nevertheless, it doesn't mean that we as an industry don't have to do anything in the future. It's on the contrary, we still have a lot of work to do. We always try to improve transparency. We always try to take into account what investors ask for, what their opinion is, what they would like to see. And that's why I would like to give you, the audience here, the virtual audience, now the opportunity to ask any questions, if there are any. Otherwise, if I don't receive any questions, either per raising hand or in the chat, I think now it's time to say goodbye. Luca mentioned we are expecting a sunny weekend. We don't want to sit between you and the sunny weekend. It's Friday already. So thank you very much. A big virtual applause to my audience. And to my panelists, of course, Luca, once again, thank you, and especially the Secretariat for supporting us. The Factbook wouldn't be possible without all the help from the ECBC Secretariat. So well done. Many thanks to you. Enjoy your weekend.
There is a question. There is a question, Sasha.
There is a question.
I saw Sylvan. Yes, I saw a hand, if I'm not mistaken, but
it could have been an applause, maybe. But Johnny.
No, it was my mistake. Sorry.
Damned. So special, nice weekend to you, Johnny. So have a nice weekend. Unless, Luca, do you want to say something to wrap it up?
No, just thank you everyone also from my side, and we will have also another event we are thinking of about Epostat, so it will be later in the year, which is the next one that we will be doing. Thank you all, and thank you, Sasha, to you for guiding the discussion today.
It was a pleasure. Thanks very much. See you soon. Bye-bye.
Bye-bye.